Hi everyone, Wally Nichols with the Asset Guidance Group weekly update for the week ending July the 8th, 2022. The employment numbers came in this morning. Everybody was hoping for like zero, and they came in hot. I mean, there were 372,000. It was like more jobs available than there are people. It's like two or three jobs for every applicant right now. So the reason that was kind of like a disruptor to the markets is because then the Fed responded is, wow, this economy is hot as the heat index outside. So what's that mean? Well, they came back immediately. Members of the Fed started pushing out into the news media another 75 basis point increase for July. And so then who knows what that goes into September and October. Now, to be fair, a lot of this is baked in, okay? So where does that leave us in terms of decision making? Well, what you do during these kind of markets, okay, when the fear is rampant and everything, be patient, okay? Be patient. We're going to manage the risk. We're going to go into the places where that doesn't mean that we're guaranteeing profit necessarily, but we are looking into those areas. We're looking about making active changes so that your portfolios are exposed to the type of risk that could yield yet a positive return even in the midst of all of this chaos. Okay, believe me, there's plenty of chaos to go around. We've had quite a bit of it this month ourselves because the folks upstairs left their sink running all night and it flooded us out. So we haven't missed a beat. We're going to power on through this, but just so you know, that's what we're dealing with too. On top of this, now doesn't distract us from watching for the markets, okay? And we've been watching for this, and at this point, okay, earnings are starting to come in for Q2. Now here's the deal. Right now they're coming in strong. That's good. All right. So the focus is going to be on, as long as where we're at right now, around a 19 multiple. It looks like these indexes are going to hang. Okay, they're going to hold about where they're at. Now the Dow is holding level. Okay, the S&P 500 and the Nasdaq both came up today and hit their heads on resistance, okay, at the 50-day, and then are coming back down and regrouping. Now, we'll see where we're going with that, but with the 75 basis point discussion going on right now, I think it's fair to say the evidence shows the majority of this information is baked in. A lot of talk about recession, a lot of talk about the impact of inflation and everything, but it does at the same time seem like prices at the pump have started decreasing. We've started to see those coming down and other energy prices coming down and the prices of goods here and there coming down. So we may have hit peak inflation. Doesn't mean it's not still growing, okay? But that's kind of where we're at right now. What we're looking for, I think, right now, and the great minds that I follow are discussing, is that because everyone's looking for recession and staying worried about inflation, like I said, these are mostly baked into the current price levels. If earnings start coming down, then watch out for that 3,600 level in the Nasdaq. In the S&P 500, I was going to take a quick look and see if I had something for the Nasdaq. If it holds at 36, then the earnings stabilizes out. Then that will be okay. If it doesn't, then you're going to be probably looking around that 10,600 level, 10,005, 10,600 in the Nasdaq. If it holds there, then okay, that's one thing. If it doesn't, if earnings start to deteriorate or some of these other factors change, then we fall back through. Then you're likely looking for a stop somewhere south of that. Right now, we're at 11,600, so you're looking at about 1,000-point move, and then so that'd be about a 9-10% move right there that we would be watching. So those are the kinds of things you have to be steeled for. In the meantime, we're looking for places to go with the money. Okay, we have certain structured plays that are available for people right now that have a 40% downside barrier to the S&P 500, the NASDAQ, or the Russell 2000. And that right now that play is closing on July the 18th. Just putting that out there, but that yield is over in excess of 10%. Okay, 40% downside protection. We're 20 some odd percent, roughly, say 15 to 20% off the all-time highs. If you went and down, arguably right now, if earnings deteriorated so badly, we could lose another 20. That would be a big move, okay? And search for levels another 20 to 25% below us, maybe 26%. But 40% down from where we are right now is a lot of protection. I think that's a very good calculated risk play. And again, the yields are double-digit yields out of that. Of course, if they're likely to be called if the indexes move back on up. But right now, going into the fall with all the other factors that are going on, this isn't likely. I think that's a lot of protection, I would argue, for people that are wanting some total return right now. And then, you get your money back at the end of the day, or if things improve towards the end of the year or the first of next year, then obviously if the indexes come back up, that'll be called, and then we can get our money back and start doing something else with it. But in the meantime, you've made 10% yield plus on an annualized basis. There are a lot of different ways to manage this risk out there. It just depends on what works for you. Looking for right now something less than this tremendously gloomy forecast that's out there. And that's when we know, oh boy, here we go. We're going to make everybody a lot of money after that. Okay, I'm going to put a wrap on it. It's hot outside. Stay cool. Most importantly, keep things in perspective. Life and happiness, that's what we want. We want purpose in life. We want to find the pursuit of happiness, okay? Until next week, you stay happy. We're going to stay happy. We're going to resolve all this other chaos around us and get things back to normal and better. I'll see you then.